Hey everyone, my name is Nick Saylor of Saylor Business Solutions and the VMG Real Estate Tax Group. And today I have a video talking about how to reach material participation status on your rental properties. This can serve you well if you're doing the short-term rental tax strategy, or if you have REP status, real estate professional status, and you want to take losses against other active income. If you're preparing to do the short-term rental tax strategy where you take a huge deduction in year one, the year that you purchase the property, against your active income, you absolutely need to get this right. And this is probably the most important piece of it because you cannot go back in time to prove hours that you did not spend and you did not record. If you don't do this right, you will not be able to take that big deduction in year one without lying on your tax return. And we don't do that. We don't make up hour logs. We do it the right way. So I'm going to explain in this video how you can track and get it right so that you can be comfortable in the case of preparing your tax return to get that deduction. And then if you were to get audited, that you'll have proper documentation to show the IRS and come out clean. So first, we need to understand the why. The IRS looks at income in two categories. It's active and it's passive income. So active income is pretty simple to think through. If you have something like a job where you get a W-2 or you have a business that you work in, this is active income. You're actively, going out every day and earning that income. The other is passive income. And you can imagine some things that would be passive income, things like dividends from investment income. It could be something like a rental property income where you aren't out every day earning this income. It's more passive in nature. So that's how the IRS classifies it. So the big thing here and why we care about material participation for the most part is if you have active income, but passive losses from something like real estate, you can't deduct those real estate losses against your active income. So what we're talking about here is how we can spend your hours in a way to make those real estate losses actually active in the eyes of the IRS, and then we could take that deduction against your W-2 or your business income on your tax return. A quick example of this is something like if you were earning $200,000 with your W-2, you would be taxed on $200,000 of income. Now, if you did a proper short-term rental strategy and created something like a deduction of $100,000, if you do it right and have material participation, you can deduct that $100,000 against the $200,000 of active income, and you would only be taxed on $100,000, which would be a huge tax savings. But if you don't do this right, the IRS would classify that $100,000 loss. They would still see that it's a $100,000 loss, but it would not be able to count against your active income. So the question is, well, how do I make these traditionally passive losses active losses in the IRS? And we're going to talk about this from the short-term rental tax strategy lens. There are two things that you need to do with the short-term rental property to take losses that you have and get them classified as active. The first is that the average stay must be 7 days or less. Now that is where the short-term rental piece comes into it. You don't need to be a real estate professional as long as your average stay at your property, your rental property, is less than 7 days. And the reason the IRS says this is because if your average stay is less than 7 days, inherently there's going to be more effort required. There's more transitionary periods between tenants or short-term tenants like through Airbnb. So it's not a traditional rental activity. So that's the big thing here. The under 7 days is to turn this activity into a non-rental activity. Even though it's short-term rent, it's not rental activity in the eyes of the IRS anymore. So number one is the average stay must be under 7 days. You need to track this. It can be done through online tools, but most easily if you are just on Airbnb, you are able to see each stay and you could put something through a spreadsheet and track that the average stay is under 7 days. The second rule, and the one with a lot more nuance, is what we'll focus on the rest of this video, and that is hitting material participation status in the activity. So even if you do have that average stay under 7 days, if you do not reach material participation with that activity, you will not be able to call these active losses. So how do you materially participate in your short-term rental? Well, let's get into it. The IRS has 7 rules for material participation, and you only have to reach one of them. So 1 of 7 is all you need, just to be clear. I'm going to put this up on the screen and a link in the description so you can read through what you think might work best for you. But there's generally 3 popular ones that people fall into that are easiest to achieve. The first one that I'll mention is the 500-hour rule. Now this is the simplest because it's just one thing you have to do and then you're all good. And this is just participate in that activity for 500 hours or more in a year. The issue here is that 500 hours is a lot of time. So if you just have one Airbnb unit, oftentimes there's probably not going to be enough work to do 500 hours in a year. but it's possible. And you don't need to track how many hours anyone else works. You just track your 500 hours and you're good to go. The second, that is usually the most popular and the easiest to get to, is the 100 hour and more than anyone else rule. So this rule states that if you participate in the activity for 100 hours during the year, it has to be in the calendar year, and you participate more than anybody else, more hours than anyone else in the property, you are materially participating. So not only in this case do you have to track your own hours, you have to track everyone else's hours. So you may spend 150 hours and think that you're good, but if you have a house cleaner who goes in after every stay and spends hours doing it, if they had 151 hours or more, you would be out of luck and you would not pass the material participation test that we just presented. There's some strategies to, work with this, but definitely you need to get your 100 hours and then just make sure nobody else works more than 100 hours. So you could, use a cleaner for half the year and then a different cleaner for another half of the year, have people on rotation. It's based on individuals, not necessarily companies. So this requires some detailed tracking, to say the least. And then finally, I'll mention this one as well. It's a bit more ambiguous, so I always encourage people and push them toward the 100-hour one to be safe, because you can very clearly track it. One of the IRS rules is that if you provide substantially all the hours and all the work in the activity for the year, that you are also materially participating. So that would mean that if you did all of the work and say it was only 50 hours, but nobody else did anything, you'd be good. So this can work great for self-managers, or sometimes people who acquire a property at the end of the year. They could spend all of the hours at the end of the year and be the only one to do it, and they would be all good in the eyes of the IRS. Now, you absolutely should still track your hours in this case to show the IRS, I did this, I cleaned, I rehabbed, I managed the listing, I did all these things, and then it gives more proof that says, if you are saying nobody else did it, well, here's where I did all of these things and fulfilled my material participation. So as I've alluded to several times, you absolutely need a log for this for two main reasons. The first is that if a tax firm such as my own or another reputable one is preparing a return where you're going to take active losses for real estate losses, or short-term rental loss, they're going to ask you for a log. They'll ask, do you have a log? Can I see the log to prove that you've done this? Because no good tax firm is going to want to just blindly say that you've achieved material participation if there's no proof. So that's reason number one. And reason number two, which is even more important, is that at the end of the day, whatever is on your tax return, no matter who prepares it, you, the individual, are responsible for what's on that tax return, and you answer to the IRS in an audit. You can absolutely get someone to help you, but if you don't have material participation and you get audited and it gets disproved, you're going to be on the hook for paying the taxes, potentially paying penalties, interest, all of that. There's a lot of risk here when you do this. So that's why we need to cover ourselves. So you need a log. I love cloud-based solutions for things like this because everything's online these days. It makes it a lot easier. You can edit it. It's better than just a paper log. So for that reason, I always recommend an online-based solution because it just helps a lot. Conveniently, the sponsor for this video is RepShield. I've worked with RepShield and I really like what they're doing. They have online time logs and tools for real estate investors, whether you're reaching reps hours or material participation for your rep status or the short-term rental tax strategy. Now, if you look at what RepShield has, if you go on their website, they have calculators that help you figure out if you can even reach these hours. They really help you if they care about real estate investors and wanting to save you money. The interface is great. The website snaps along really well, and they work on a subscription basis, a very affordable subscription. You can even do it annually to save a lot of money. So I absolutely recommend checking out RepShield. I'll show you a few things here on their interface. I just want to show you inside of RepShield to see how snappy the interface is and how it integrates with AI. Really clean look. Here's the dashboard. You can see your time tracking progress between long-term and short-term rental strategies. They have different material participation requirements, as I'll explain shortly. So you can check out how this works. Here we have the time tracking. So if you have the web app, you can literally start it as soon as you start a project and it will, time track for you. You can scroll down. It actually has integrations with Google or Outlook Calendar, which is great. So it can look at what you have on your Google Calendar and will directly import it in. It uses AI to suggest different types of what you're doing and even to beef up your descriptions for what you write. After you've made some entries, you have this audit log of every time entry that you had, and you're able to categorize everything, assign it to specific properties, say, what properties it's linked to, It's really neat for tracking everything and having it in one spot. And this is exactly what we're looking for if we're trying to prove to the IRS that, we have material participation, something like this. They've probably never seen something so good before. When they see how on top of it you are, you should be good as long as you are tracking your hours and hitting the requirements that we've explained. We've got AI analysis here. We've got PDF integrations. You can upload documents that it will read and pull it in. It's really cool. There's more rules that you can set up. So you can say, if it's called this, or this title is in the name of my Google Calendar, when it pulls it in, it will stick it onto the correct property. Really cool. When I first looked at this and started using it, I was just shocked at how well this is built for being a newer product on the market. And then finally, maybe my favorite part is the analytics dashboard here. You can look at this for detailed insights across your properties, or in total if you're doing bulk gatherings. You look at total hours, you can look at tracked on certain dates, the activity breakdown. This will give you a really good idea. You can share it with me or your accountant to look through it. And then finally, if there wasn't enough, there's also an AI assistant that's trained to answer specific questions based on material participation and hour tracking. It's a really robust tool that if you're tracking hours in the new age, not on a paper log, this is the way to do it. So highly recommend you check out my friends at RepShield. So now that you have a good solution for tracking your hours to reach material participation, I want to talk a little bit more about what hours count as material participation and what doesn't. A lot of people think that, researching or traveling to go look at Airbnbs when you're in the process of working with a real estate agent to find the property count as hours, and generally they don't. It's very clear with the IRS that travel time does not count. So if you're traveling back and forth, or even after you buy the property, if you say it's, in Florida and you're in New York, you can't just take a 20-hour drive down there and count 20 hours. The IRS has had court cases with this, and it always disallows those kind of hour counting. The IRS is also clear that investor-related activities do not count toward your material participation. So if you're looking at this from like a high level as an investor and analyzing the financials at an investor level, or like you were kind of just sitting back and letting the property run from you, your bookkeeper sends it to you, that sort of thing, those hours do not count either. Now, there is some discussion over, when we're under 7 days, it's technically not a rental activity. The IRS is clear that researching and, acquisition of a rental property does not count as hours. But since this technically isn't a real estate activity, there is an argument to be made that when you're researching and acquiring a property that the hours could count. I like to err on the conservative side and not count those. My rule of thumb is that as soon as you acquire the property and you can start working on it, that's when I recommend starting to track hours, just because it can be bulletproof in an audit and you don't have to get into an argument over a tiny piece like that. Next, you need to know whose hours you need to track. And again, you should know what hours you are. And again, you need to know what rule you are trying to obtain to hit that material participation status. But my favorite thing here that I'd like to mention is that if you are married, your spouse's hours can count as well. So if you do 50 and your spouse does 50, that's 100 for your household. And, you file a joint return. So your spouse's hours do count. So this is where it can work out really well, where you have, high earning husband or wife in a W-2 job. And then you have the other spouse get those hours and manage the short-term rentals or, the rental activities. So you should absolutely always track your hours and your spouse's hours, because that counts toward your hours in total. And then again, you do need to track everyone else's hours in the activities, so that, that's housekeepers, that's bookkeepers, really anyone, contractors that work on rehab, any person that does things on this property, they count as hours. So if you're going for the 100-hour test and more than anybody else, you need to track anyone else who works in the property so that you can prove it. One more warning notice I want to give you is that you absolutely should just track realistic hours and truly track what you're doing. There was a court case that I read about where the IRS, dug into a time log of an investor and found that they didn't believe the time that was listed for certain activities, things like 2 hours listed to go to Target to get dryer sheets or something like that. So the IRS can get very granular, and whether they have proof or not, if they don't believe what's on your log, they don't have to allow you material participation status. So again, there are all these ways that you can, try to get around it or cut corners, but that opens you up to risk and it doesn't follow the rules. So I really recommend using something like RepShield, tracking your hours, turning it on when you start, turning it off when you're done, and getting to those hours in one way. So the easiest way, in my opinion, is the 100 hours and more than anybody else. But again, if you're at year end or you truly are the only one who works in the Airbnb and it is, fairly passive while keeping it under 7 days, if all of the hours, then you are materially participating by the IRS rule. I do want to throw out there, do not confuse this with the 750-hour rule that is required to reach real estate professional status, sometimes called REPS. That's a totally different thing, and I'll explain that in another video coming shortly. And even if you do have REPS, you still need material participation to write off these losses. So this is important no matter what you're doing. If you're ever trying to deduct losses against active income from real estate, you need to follow material participation rules. So in summary, if you are doing anything to deduct real estate losses against your active income, you absolutely need to reach material participation. Go ahead and check out our friends at RepShield to help you out with that. And I do have an affiliate code below if you'd like to check them out. I just wanted to bring this video to you to make you aware of what you need to do to reach this status so that you don't get any surprises at tax time. As always, thanks for watching. Comment if you have any questions and have a great rest of your day.